So welcome everyone to our first 3CL seminar. It's a great pleasure seeing you here today. I hope you all arrived well at Cambridge, and it's a very great pleasure introducing Professor Luca Enriques, who came over from Oxford to us today. Luca is the Professor of Corporate Law at the University of Oxford and a research fellow at the European Corporate Governance Institute, where he also chairs the research committee, and he's a member of the board. He's also a fellow academic member of the European Banking Institute, and he co-chairs the Fintech Working Group. He has published widely in the fields of comparative corporate law, securities regulation, and banking law. He has held visiting positions, amongst others, at Harvard Law School, Sydney Law School, and also here. So you've made very good choices, Luca, as you have made today, and we are very happy to have you here. You're also advising ministries from time to time on regulatory issues. And as always, we'll first have Luca's presentation and then a discussion, and we'll end sharp at 2 p.m. Luca, thank you very much for coming over today, and the floor is yours.
Thank you. It's my great pleasure to be back in Cambridge after quite a few years. I was here as a visiting lecturer in 2015. I was here in 2002 at 3CL, thanks to the general hospitality of IDC. And so I'm back, and I'm very glad to present a paper to you, which is still in a very preliminary, actually incomplete form, in the sense that we basically have three papers in one, and we have to find a way to make it, to separate them and make each of them readable. That's our main problem now. But the intuition is very simple. This project, which is to ask whether Italian and German corporate law came to be an obstacle to the use of US-style venture capital contracting. So I don't know how much cognizant you are, familiar you are with venture capital and how the contracts between the venture capitalist and the entrepreneur work. I will tell you more about this, but what is, you need to know is that venture capitalists are the main source of funding for highly innovative firms. They are almost, so they are often associated with the Silicon Valley, and if I can give you a tip for a series to watch on one of these streaming services, Silicon Valley is a great series. I really recommend it. And it gives you a quite credible, albeit extreme, insight into how things work there. And so there are these VCs, as they are known, who will give money to these geeks, will try to come up with a product without knowing whether, in some cases, there will even be a market for the product, let alone a successful product. And so these are high-risk ventures, and the practice has developed in a way that basically uses contracts and corporate law to shape the rights and the powers of the two parties in a way to minimize basically the transaction cost of this investment and with all the difficulties that come with it. So this paper looks into this question. There has been a huge growth of venture capital in Europe in the last, especially in the last 10 years or so, because the interest rates were very low, and there was of course, innovative firms are all the rage everywhere, and there were Europeans' attempts to build unicorns, and the VCs were instrumental to this. So we will show actually that there is a problem with Italian and German, and by implication European corporate law when it comes to piggybacking on the US experience of venture capital contracting, and we then speculate on what the implications can be for policy. So there is a literature already out there which looks at the relationship between the institutional environment, which includes law and corporate law, and the development of VC markets. So a number of studies have been made in the last 20 years or so, which use the law and finance literature, which was very popular back that time in the 2000s, which had purported to find a causal relationship between having a common law legal origin and stock market development, so that so common law origin countries were more likely than civil law origin countries to have well-developed capital markets. That was the idea, and it was an empirical investigation that led to the building of indexes. These indexes were used by scholars to test whether corporate law, for example, in terms of the quality of investor protection in a given jurisdiction, may also explain how well-developed venture capital markets were. And so there were papers that found this kind of correlation. Mainly, the idea was that with better protection of investors, it was not necessarily the relationship between the venture capital and the firm that would be facilitated, but rather the fact that capital markets, public equity markets, were more vibrant, and for VCs, for venture capitalists to make money, there needs to be a certain ease for the funded firm to go public, to list on the stock exchange. So if there is a correlation between good corporate law and development of securities markets, then it works also ex ante for the development of venture capital, because it's easier to exit making a lot of money for the venture capitalist if that is the case. But these studies looked at a very stylized conception of corporate law. They built indexes, and they were very rough in terms of understanding what corporate law can or cannot do. And there is also a paper that argues that, in fact, you can observe all around the world, even in non-common law countries, the use of US-style venture capital contracts, which, according to these studies by Kaplan and co-authors, is a sort of an efficient contract, a model contract that has been developed throughout the years that will provide for an efficient governance of the relationship between the two parties. And these contracts are a good example of a Coasian bargain, in the sense that it doesn't really matter what the law says that are the rights and duties by default of shareholders, because the VCs and the entrepreneur will reallocate all these rights in the way that is most efficient. And so they noticed that these terms are also used in a number of jurisdictions, and therefore perhaps corporate law is irrelevant. If they are using it, it means that everywhere you have the same kind, you must have the same kind of elasticity, flexibility of corporate law that you see in the US. But in fact, we argue that while we cannot confuse, we cannot dismiss the fact that these are used, we argue that there might be a legal risk using them. But I will talk about that later. So, as I said, this law and finance literature gives quite a general view, takes quite a generic, superficial view of corporate law quality, and we argue that it misses something very important, because corporate law is always there, both in the US and elsewhere, and it's the background against which parties contract. If corporate law is enabling, that is, it doesn't provide for mandatory provisions, but allows parties to deviate from the rules that it sets in general as default rules, and parties can do what they want, then you can come up with whatever configurations of rights and duties within the corporation as parties see fit. But in fact, it is not the case that corporate law is everywhere so flexible. Actually, in some jurisdictions, the law contains quite a number of provisions that parties cannot opt out of. And when that is the case, you have to check whether what parties do in the US can in fact be done elsewhere in terms of the legality of these rules, which may well be null and void, because in contrast with mandatory provisions. As I said, just to go a little bit more into the detail, US corporate law is enabling law. It has mainly default rules. The only quote-unquote mandatory core of US corporate law, specifically Delaware corporate law, which is used also by VC-funded firms, the only mandatory core is the duty of loyalty or good faith, but it's mandatory only in the sense that parties have chosen not to deviate from it. In fact, if a company is set up as a LLC, limited liability company in the US, parties can even opt out of fiduciary duty, but they don't do it in practice. So that's the only mandatory core. Everything else you can move around and shape shift as you wish. And so it's called shape shifting, that what you do with the contractual arrangements that will align the organization and the ownership of portfolio firms with the VC funds objectives and possibly also with the entrepreneurs' objectives. Of course, the VC funds are repeat players in these markets, whereas entrepreneurs are not. So there are those who fear that, in fact, the terms of the contract are a little bit too skewed in terms of making the interest of the VCs rather than the entrepreneurs. But and so some are skeptical that this is indeed the efficient contract. We actually take a more optimistic view in the paper and argue that because they have survived through cycles of VC investment in the US, there should be a presumption that overall these contracts are efficient, or at least that they optimize the expected returns for both parties. So what do these VC contracts do? They allocate cash flow and governance rights. They do so on a contingent basis, in the sense that they have elaborate clauses that will define what the VC on the one hand and the entrepreneur on the other will get, depending on how well the funded firm does. If the funded firm does very, very well, then a contingent on this, the entrepreneur will make a lot of money, will receive a huge amount of shares of a company that has done well, therefore is valued a lot. If things go badly, on the other hand, the entrepreneur will lose everything, and the VC will be paid first. So it will have liquidation preferences in bad states of the world. And the allocation of cash flow rights is totally independent from the allocation of governance rights. So once you have, logically, once you have allocated cash flow rights, then you decide what powers the two parties will have. And again, it will be on a contingent basis. In some states of the world, the VC will have total control over the firm, and especially the decision on whether to continue the business or whether to liquidate. In other states of the world, the entrepreneur will regain control over the firm. And so this is, in a nutshell, what these contracts do. And so, in other words, private ordering here it does the trick, and of course it's not cost-free. You know that there are costs of contracting, there are transaction costs, both ex ante when you have to negotiate the contract, and ex post once you have to deal with the contract that exists, and you may have problems of opportunism and hold-up and so on. So you can think of corporate law as having an effect on the magnitude of transaction costs, because if it is to a certain extent, higher or lower extent, inflexible, then some solutions that the US BC deals practice has come up with may not be available because they may be against the law, which would mean that parties will have to find inferior solutions or a solution that may approximate as much as possible what you can do with the US clauses, but that approximation may not be total, and therefore you may have an inferior solution. And in addition to that, jurisdictions differ on another metric, which is how much certainty there is about whether a certain rule exists or not, has a certain meaning or another, and therefore this additional uncertainty may add to the transaction cost, because if you don't know whether a certain clause is valid or not, you may try and litigate and find a court that may, for example, say that a certain rule is not valid. And so the argument is that when this is the case, when there is a certain degree of inflexibility, then corporate law, at the margin at least, may prevent some venture capital deals. So it may eat out in transaction costs some of the value that is created, and again, at the margin, some companies, some firms may not get funding for that reason. In other words, the cost of funding should go up if transaction costs are higher. So we make no attempt in the paper to quantify this effect. We have no clue whether it's trivial or not. And we also should make clear that our claim, that is our conclusion, that there are indeed these effects, is not contradicted by the fact that there has been a boom in VC markets in Europe in the last 10 years, because there is no counter proof that there wouldn't have been even more venture capital investment without these issues. So again, to go into slightly greater detail on what the venture capital deals do in the US, I give you here 3 examples of clauses that you always find in venture capital deals. So first of all, venture capitalists invest via convertible preferred shares. Convertible preferred shares are a hybrid between a bond, so they have a right to receive interest on the shares, but also they share in the upside. So if things go well, they are shares that will receive dividends, and this gives a big advantage to the VC in bad states of the world, because they can get their money back before the entrepreneur is paid anything. And in good states of the world, they can convert into ordinary common shares and get their share in the capital gains, etc. In terms of governance, for example, we have corporate opportunity doctrine waivers that allow companies, VC-funded companies, to let their directors off the hook, even when they are the expression of VCs, if a corporate opportunity is exploited by another firm that possibly is funded by the same VC firm. And this is because given the fact that each VC firm has a portfolio of companies that may be doing exactly the same kind of R&D on the same product, it may be very, very difficult exposed to understand whether an opportunity that arises at one firm was in fact a corporate opportunity of another firm. So to avoid litigation on these issues, it is more convenient just to waive the rights that the company would have against directors. And finally, all these contracts have drag-along rights, so that if the VC wants to sell their shares to a third party, when they have the right to do so, the entrepreneur will have the obligation to sell at the same price, so that the buyer will buy 100% of the shares, which is what usually you want to do. And so this facilitates exit for entrepreneurs. As I said, these contracts are, we can presume them to be efficient, and we observe them in other jurisdictions as well. The question is whether we may consider more carefully whether in fact the observed practice is also consistent with the law, or whether there are legal risks. And we conducted analysis of the main, actually a number of venture capital clauses that are commonly used. I will give you just 3 examples here very quickly, because I'm more curious about your questions, and I may get back to them. But before I give you these examples, I just wanted to notice that the landscape that we observe in Europe, Germany and Italy specifically, is one in which lawmakers, reformers made an attempt in the last 20 years or so to make the legal landscape as favorable as possible to VC investment, because there was this idea that the European economy should be more dynamic, more startup friendly. And so there were a number of reforms, both in Germany and in Italy, which attempted to go in the direction of making life easier for VC investment and for innovative firms. Another thing that I should clarify is that despite Centros, which is a case from 1999, which appeared to have opened the floods of regulatory competition within the EU, because it said that a company could be established in the UK without having any connecting factor with the UK, so that it looked like if you were an entrepreneur in Germany, it would be, and it was in fact the case for some time, that people did come in the UK, set up companies here and do business in Germany. What we observe is that this is quite costly, and therefore not done de facto by VC-funded firms. So they are de facto captive of local markets. One reason is that these are relatively small deals, and if you add the complexity of a different jurisdiction to the picture, the legal costs will go up considerably. And that's the main reason why they don't use, actually Bobby gave me this insight in London the other day. This is in fact the reason why they don't use US law, because then you have to use the US corporate lawyers, which are really, really expensive, and these firms do not have the means to afford this. And so we focus just on Germany and Italy because there are 3 co-authors, 2 are take care of Italy, 1 of Germany. We have expertise in these jurisdictions. And didn't want to make claims about other jurisdictions that we may not be able to support. But what we argue is that what we find is indicative of continental European corporate law. So it could be easily extended to at least some other European jurisdictions. And I'm aware that someone is doing the same exercise with France as we speak, and someone is doing it for the Netherlands. I don't know the results yet. But and finally, and importantly, we look at the law in action, not the law on the books, what the statutes say, corporate company law acts say, but how these are interpreted by legal scholars, practitioners, and courts, which makes all the difference, as I will say. So when it comes to the 3 clauses that I mentioned to you before, none of them is actually available according to the law in these states. By the way, are there any Germans or Italians in the room, apart from Felix? You are from Germany?
Yes.
Okay, I'm ready to be disproved if you have better information than me and my co-authors. We have found that conversion rights are held to be in contrast with the information function of the charter by German legal scholars, because the charter should make clear what the rules of what the cash flow rights are for each individual company, for third parties to know, and this uncertainty that comes with the conversion rights is considered inconsistent with that. There are, in Italy, there is this idea that if you take the concept of the corporation, which is a common enterprise with a common risk, you cannot have this kind of structure and liquidation preferences because one of the shareholders would not share in the risks of the venture, and so on and so forth. So we have tens of clauses that we have found, not just one scholar, but let's call it the prevailing scholarship to argue that these are against the law. So what can you do? You can try to find the functionally equivalent solutions. Unfortunately, that doesn't always work. Oh, sorry, but the drag-along rights are also interesting because there has been a case law or doctrinal works in Germany that have clarified that yes, drag-along are okay, drag-along rights are okay, but the entrepreneur, the dragged-along shareholder, has to receive fair value. So, and that basically kills it in the sense that it gives the entrepreneur a route to litigation, which makes the exit far less easy for the entrepreneur. So we find that therefore functional equivalent doesn't always work, also because often legal scholars and courts tend to read the law in a way that prevents circumvention of mandatory provisions. You cannot reach a certain outcome, the same outcome that the law forbids, by using another form. That's very common across jurisdictions, and Italian and legal scholars are quite creative in finding arguments in favor of basically judging some functional equivalent solution as also not in line with the law. So I want to wrap up because, again, I want to hear your comments. The answer to our initial question is that it is difficult to replicate US-style VC contracts in Italy and Germany, and perhaps by extension in continental Europe, because not often because of what the law says. So there are a few cases in which the black letter law, the statute itself, has a negative solution. That's, for example, the case for the automatic and cumulative dividends that VCs reserve themselves. There are actually, in this case, and it's a very rare case, it's the European Union rules that prevent this from being legal, because the dividends can only come out of profits according to these rules. But other than that, it's almost never the case that European law is in the way. It's rarely the case that you find in the law explicitly the problem. Most of the times it's a doctrinal interpretation, which uses analogy and general principle, implicit general principles of law, which lead to this outcome. And so we make this conclusion, and we argue that therefore it matters. There is, of course, the plain fact that at least some of the clauses that we find to be inconsistent with the law are used in VC contracts in Germany and Italy. So one may ask, why is that the case? Well, first of all, as I said, the legal costs are a real concern for these small firms. So that if there is an off-the-rack set of clauses that you can pick from, you may do that, even if you don't want really to find out how stable they are should you litigate. Also, because litigation for these firms is quite unlikely anyway. And in addition to that, it may be the case that VCs and firms prefer to have these rules in place rather than nothing. And finally, it may just a way to corroborate social norms, to instill in the entrepreneur the idea that this is the way things are done in the VC industry, no matter what the law might say about the legality of what we do, and therefore try to build upon reputational concerns on the part of entrepreneurs, not to question the validity of these rules, and actually to follow the contractual arrangement that they have agreed to. So we don't know how practically speaking, this may lead to lower VC investment in Europe. What we may see soon is that after this boom of VC deals, there will be problems with refinancing these firms, because with the higher interest rates, the opportunity cost of investing in projects that will yield a return in the far future are lower on an expected value basis. So it might be that many of these funded firms will go under, at which point we will see which legal system, to quote Warren Buffett, is naked when the tide goes down. And the one implication for policy, for sure, is that deregulation in this jurisdiction doesn't work if deregulation is merely repealing mandatory provisions, because there is, and Italy was a good example of this, there was a deregulation in 2003. It practically had no effect, because a couple of decades of legal scholars' interpretation of the new rules led to them being read with the same glasses as before, which are glasses that tend to find implicit general principles that prevent certain solution from being found legal. That is all, and so I thank you very much for your attention and look forward to your comments.